I think most investors have rebalanced along property sector lines the way they've wanted to. They're certainly in the process of doing that. So on a go-forward basis, I think it's going to be much less about what specific property sectors you're targeting, probably a lot more about the quality of the individual properties, the quality of the individual locations. Micro locations are becoming much more important in the investment decision than, say, market decisions. So
Hello, welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. Today we're discussing some of the main themes and trends in commercial real estate with my guest, Mike Acton. Mike is Head of Research and Managing Director at AEW Capital Management. Mike, thanks for joining the podcast today.
Oh, great. Thanks for having me.
So, Mike, to start off, how would you describe the macro backdrop for commercial real estate heading into the back end of 2024?
Yeah, the macro backdrop is a bit mixed right now. On the one hand, markets are very excited that the Federal Reserve appears poised to start cutting interest rates. Borrowing costs would go down. Presumably more liquidity would come back to markets. That's all to the positive. But when people stop and think about what that really means, it means the Fed's concerned about the underlying economy, they're concerned about growth. Certainly, there's been a lot of articles and stories about increased risk of recession, things like the so-called SAM rule that the Fed uses and various other recession indicators. They've all been flashing that we should be concerned about growth for quite a while. It's an interesting time. We've got an election coming, going into a new year. You don't really know for sure what set of policies are going to be pursued and so on. So I'd say it's a little bit of a mixed bag as far as the broader outlook goes.
And it seems that values in the REIT market may have bottomed a couple of months ago. Is commercial real estate far behind?
Yeah, so historically, if you look at the data, equity REIT share prices lead the private direct real estate market by about a year, give or take. And in the US anyway, equity REIT share price indices all bottomed out towards the end of last year, actually around October. So that year would say we're getting very close to should be. There's some data you can look at to try and identify that bottom. I would say that the hard data is a little scarce right now. There's certainly more impressionistic or anecdotal kind of information about investors starting to feel like we're very close to a bottom. It's been 8 straight quarters of private market value write-downs as measured by things like the NCREIF property index and such. Yeah, it feels like we're getting pretty close to the bottom.
What are you seeing in the way of transaction activity across the commercial real estate industry? Are any patterns developing, and what is determining whether deals are getting done?
Deals get done when there's capital available and you can finance them. And today, both those things are a little bit in short supply. There's certainly interest in adding to real estate allocations. A lot of institutional investors just aren't getting much money back from funds and strategies that they've been invested in. And that always hampers how much new money one can put out. The debt side's a little more complicated. We've had constrained lending markets in the US now for a couple of years, in particular bank capital. And then within banks, it's really particular to regional banks and smaller. The money center banks still have plenty of money to lend. Of course, the cost of all this capital is higher, right? People are charging higher interest rates. There's more conditions associated with the debt. It's the capital availability, particularly on the financing side, that always limits transaction activity. And when you pull it back, if you look at the actual hard data on transactions, the total aggregate volume of things that are selling in the US today is pretty low. It's about the same nominal value as it was about 10 years ago. Before COVID, steady state, US would have, in a normal year, $500 to $600 billion of commercial property trades. That went down quite a bit during the COVID years, as you can imagine, dropped to about 400 billion. And then in the period after that, the Federal Reserve took interest rates to near zero. Government flooded the economy with cash. Liquidity soared, and that transaction activity shot up to well over $1 trillion on a trailing 4-quarter basis. And now it's dropped precipitously. The transaction market has really slowed quite a bit. And there's anecdotal evidence that's starting to change. We have a pipeline meeting every week in our shop. There's more and more things coming to pipeline, things to talk about, deals that are coming to the market. Now, we're still probably a few months away from seeing those actually show up as closed transactions. But I think everyone's anticipating that transaction volumes will pick up through the end of the year and certainly into 2025.
And what about particular property sectors? Are you seeing more activity in some than others?
Yeah, there's been a pretty big shift, I'd say, over the last 5 years. Even before COVID, office properties were becoming of less interest to some investors. Certainly investors in core real estate strategies, much less interest in things that have a lot of capital needs. Office buildings need a lot of capital. And sign a lease, you have to give your tenant a lot of money to make the space look like the way they want it to look. Large shopping malls have a lot of capital needs. So these investments, these property sectors that were more back-end oriented in the return, less cash flow oriented, they were already becoming of less interest to a lot of investors even before COVID. And then COVID really accelerated a lot of these changes. In a short story, if you were more concentrated in things like warehouses, industrial property, or in apartments the last several years, you probably did pretty well. I think most investors have rebalanced along property sector lines the way they've wanted to. They're certainly in the process of doing that. So on a go-forward basis, I think it's going to be much less about what specific property sectors you're targeting, probably a lot more about the quality of the individual properties, the quality of the individual locations. Micro locations are becoming much more important in the investment decision than, say, market decisions. In the past, maybe 10 years ago, people would mostly talk about, I'm going to allocate to coastal gateway markets, I'm going to allocate to southern growth markets. And that's still all true to a certain extent. But now it's a much more nuanced and detailed sort of location decision and specific property decision as well.
I was going to ask you about how you come up with a well-balanced portfolio, but it sounds like it's taking a lot more effort now.
Yeah. The well-balanced portfolio really is, it's partly a function of what you're trying to achieve in real estate. If we were to say limit the discussion to what does a true core diversified investor look for today, I think it does break down largely along those lines that I was just mentioning about the nature and the character of the cash flows of what you're investing in. Core real estate investment, I think, is largely defined by having a lot of your return come from current income, much less of it being residual equity oriented. That takes a lot of the volatility out of the returns. If a lot of your return is 10 years in the future and it's pinned to selling the property at that point in the future, obviously there's a lot more potential volatility in that decision. So I think people are much more focused on property sectors where a lot of the return is the current income you get today. And that would lead you to apartments. It would lead you to warehouses. It might lead you to some of the smaller sectors like self-storage, perhaps. I think a lot of things in residential are of a lot of interest to investors today. The U.S. residential market is just a very big, liquid, deep property market, one of the most liquid property markets in the whole world, really.
And leading on from that, residential sector, affordable housing, is that an attractive place to be today?
Yeah, affordable housing a lot of it's in the definition of what you call affordable, right? But many investors are interested in investment strategies in the affordable space. At AEW, we refer to that as essential housing that really serves a purpose in the economy. You could almost think of it as social and economic infrastructure in a sense. But I think a lot of investors are attracted to it for a lot of really valid reasons. The returns are very cash yield oriented. The tenant base in that part of the residential market is very stable. For the most part, if you're a household that has an apartment that works for you, that is affordable to your income level, really anywhere in the US. It gets you close to your job, it gets you close to the school that your child goes to, or the school you want your child to go to. And most importantly, it's affordable relative to the level of your income. That's a really hard thing to give up almost anywhere in America because you can't easily find a replacement for it in the same neighborhood, the same geographic location. So if you gave up that unit, you might be talking about moving quite a bit away, getting maybe on a new transit line, maybe you have to go to a new school, all those things that go along with that. The tenants are very stable tenancies, are good for properties. They reduce a lot of the operating expense. So I think an awful lot of investors are seeing the opportunity in the affordable space. And really, it's an area that institutional capital historically did not pay much attention to.
Are there other themes or trends impacting commercial real estate that you'll be watching closely for the rest of this year and into 2025?
Like as I said at the beginning, the big story is all eyes are on the Fed, right? Across all the asset markets, investors everywhere are super focused on how fast is the Fed going to move on interest rates? How far do they take them down? What does that ultimately do to the longer end of the yield curve? Because really, when you get right down to it, many asset classes, real estate certainly, price in some relationship to where the 10-year treasury yield is. So investors today are reflecting on what they just experienced over the last 10 or 15 years. Low overnight lending rates by the Fed translated into low long-term treasury yields. Now, that may or may not happen again on a go-forward basis, and this is really one of the big open questions. The Fed may well cut interest rates quite a bit, and we'll have to see if the bond markets respond and bring the longer end of the yield curve down as well. Most of my life, the yield curve's been upward sloping. The last 2 years have been a little different. It hasn't been upward sloping. I think some investors have been conditioned to believe that low overnight rates lead right away to low longer yields. So that's one thing. And then, of course, ultimately, everything relies on how the economy does. Property is a really interesting asset class. It can really only be as successful as its tenants. All commercial property exists to serve its tenants. That's really the only reason we have commercial property. And if your tenants are healthy and they're producing income and profits and wealth for themselves, ultimately that accrues to the properties in the form of higher rents. And then if the higher rents stay around long enough, ultimately investors will capitalize that into the value of the asset. So almost everywhere in the economy, you're really depending on underlying economy performing well for your real estate investments to perform well long term. Now, like I said, there's a lot of questions about the economy right now. There's a lot of controversy, if you will, about the employment data recently. Are we counting jobs right, or have as many jobs been produced as we thought before? All these sort of questions. But there are definitely signs that the economy is slowing. And if you pull back, that's really why the Federal Reserve is starting to reverse themselves on interest rates. They're starting to see those same signs of a slowing economy. Whether or not it tips over into outright recession or not is a very open question. And it's probably a story probably for the first part of next year.
Mike, thanks so much for your time.
Yeah, of course. Thank you.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.